On Monday, a rebel group in Yemen closed the western door out of Saudi Arabia's oil business. The eastern door has been under fire for 10 straight nights. One country, both exits at the same time. Oil broke $90 for the first time in a month, and every headline you've read since says the same thing. This only goes up. I want to show you why the biggest move nobody is positioned for is the one in the other direction. Okay, the setup, because the map is the whole story here. Saudi Arabia sells oil to the world through two narrow passages. To the east, the Strait of Hormuz, the famous one, the sliver of water at the top of the Persian Gulf. To the west, a passage called Bab el-Mandeb, between Yemen and Africa, which feeds into the Red Sea and up to the Suez Canal. For decades, the whole point of having both was insurance. If one gets difficult, you send the barrels the other way. That is the entire reason the Western route exists. And on Monday, that insurance policy got canceled. The Houthis, the Yemen-based group aligned with Iran, declared a blockade on Saudi-linked traffic through that western passage. Their stated reason was the Saudi campaign in Yemen. And the numbers behind it are genuinely serious. That waterway normally carries around 12% of everything traded on Earth, about a quarter of the world's container traffic, and roughly 5% of its oil. A full closure would put oil equal to about 7% of global supply at risk. Meanwhile, flow out of the Persian Gulf is already down about 10% since the war started. So oil went up. Brent hit $89.93, up $1.71 in a session, about $20.50 higher than this date a year ago. Gold sits near $4,030 an ounce, bid on exactly the same fear. And the entire market reached one conclusion. Buy oil. It can only go higher from here. Except, while all of that was happening, mediators from Pakistan and Qatar put a ceasefire proposal on the table. And according to the reporting, that proposal does not just pause the fighting. It includes lifting the restrictions on the Strait of Hormuz. Now, it is a proposal. It is not signed, and I am not telling you it will be. But sit with what it means. The single loudest trade in the market right now is a bet that these doors stay shut. And there is a document in circulation whose entire purpose is to open one of them. And here's the mechanism almost nobody spells out. When a war breaks out near an oil route, the price does not rise because barrels have stopped arriving. Most of the time, they haven't. The price rises because buyers start paying extra today for the risk of them not arriving tomorrow. That extra is called a war premium, and it is not a physical thing. It is a stored-up expectation sitting in the price, which means it does not need a single tanker to move in order to disappear. It needs one press conference. Physical shortages take months to build and months to clear. A premium made of fear can be deleted in an afternoon because the only thing that has to change is what people think is about to happen. That is the asymmetry. The upside needs the world to actually get worse. The downside just needs it to stop getting worse. Now, the part that turns an observation into a real edge. It is not enough for a move to be possible. Somebody has to be wrong-footed by it. And after 10 nights of escalating headlines, the positioning and energy has become extraordinarily one-sided. 10 straight nights of strikes. A blockade announcement. Oil through 90. Every one of those headlines pushed money the same direction, and none of them pushed any money the other way. When a market spends 10 days learning one lesson, almost nobody is holding the other side of the trade. And that is precisely the condition under which a single-piece headline does not produce an orderly decline. It produces a gap because everyone tries to leave through the same door at once, which, given what this story is about, is either poetic or exhausting, possibly both. So here are the two numbers to hold side by side. 7% of the world's oil supply is genuinely at risk if that western passage closes completely. That is a real threat, and I am not waving it away. And Brent is at $89.93, having already priced 10 nights of exactly that fear. At the same moment, a truce proposal that would reopen the other passage is being passed around by mediators. Both of those things are true at once. The market has enthusiastically priced the first one. It has priced almost none of the second. Now, let me argue against myself properly, because otherwise I'm just selling you a story. 3 real ways this is wrong. 1. Proposals fail constantly. Mediated ceasefires in this region have collapsed before the ink dried, And if this one does, oil does not sit still, it goes higher, and the blockade becomes a physical supply event rather than a fear event. 2. If barrels genuinely stop moving, the premium stops being a premium. It becomes an actual shortage, and shortages do not unwind on a headline. They unwind on new supply, which takes months. Watch the physical shipping data for that, not the commentary. And 3. Being right about direction and wrong about timing is the same as being wrong. A war premium can keep building for weeks before it breaks. So none of this is a case that oil must fall. It is a case that the risk in this market has quietly stopped being symmetric, and that the crowd is only insured against one of the two outcomes. So here's the test, and I'll put it on the record so you can hold me to it. My call. If a ceasefire, including relief on the Strait of Hormuz, is actually announced within the next 30 days, Brent trades below $80 within 10 sessions of that announcement. If a truce lands and oil holds above 85, I'm wrong, and I'll say so right here. Meanwhile, the thing to actually watch is not the war coverage. It's the ships. Rerouting tankers tell you the blockade is biting and the risk is becoming physical. Tankers resuming their normal route tell you the premium is about to have nothing left to stand on. Here's what I'd take away from all of it. Markets are very good at pricing the news that has already happened, and strangely bad at pricing the news that is sitting on a negotiating table in plain sight. 10 nights of war taught this market exactly one lesson, and it learned it extremely well. The question worth sitting with is what happens to a market that has spent 10 nights learning to price war, when the very next headline it gets is peace. Earl's full daily brief is on the channel, with the whole board, the chip story, and the crypto bill. I'm Frankie, the asymmetric signal. One contrarian read a day. Subscribe.